is the proper governance structure of your firm's treasury operations? Is treasury centralization always the best approach? Welcome to CurrencyCast. My name is Agustin. I'm the Senior Financial Writer at Cantox and your host. In this episode, we have the pleasure to welcome Justin Callaghan, CEO of FTI Treasury, and a world expert on treasury outsourcing. Justin, a very warm welcome to you, and thank you for joining us on this episode of CurrencyCast.
Well, thank you very much, Agustin. It's great to be invited on. I've followed the CurrencyCast series, so I'm a bit of a fan. I know what's in for me here. You like to get under the hood, so I'm looking forward to a good conversation.
That's great. Justin, can you start by introducing yourself to our audience, please?
Sure, yeah. Well, look, as you've already said, my name is Justin Callaghan. I'm the Chief Executive Officer here of a company called FTI Treasury. We're a Dublin-based treasury services company. We specialise in providing treasury outsourcing services in the main to multinational entities. And those services fall into two kind of main buckets as we would see them. The first are what we would refer to as in-house banking operations. And the second would be resource and support for treasury services. So on the in-house banking side, we would typically see things like looking after cash and liquidity management structures, helping implement FX hedging strategies, managing intercompany netting, accounting output, currency forecasting, and cash forecasting. Whereas on the treasury support side, we would typically be providing treasury systems, middle and back office services. As I said, our clients are all multinationals of varying size in terms of revenue. So anything from kind of $2 billion up to maybe $200 billion. The key characteristics that kind of tie them all together is that they all have a global footprint, which means they all bump into these sorts of issues that we can help them with. And in particular, things like FX exposures, counterparty risk management, cash and liquidity management are things that we look at on a day-to-day basis on behalf of our global clientele.
All right. Well, I'm sure we're going to discuss all of those topics, but let's start with the broad issue of the governance of treasury operations, and in particular that trend towards treasury centralization that we see in all FX surveys. And Justin, what lies behind this seemingly unstoppable trend towards, say, centralization in general? Is it the need for better cash management solutions on the heels of pandemic, wars, inflation, and even some high-profile bank failures? And even at a more basic level, can you start by defining centralization itself?
Yeah, sure. So I mean, you've raised a lot of topical issues there, and I would actually take a step back even further, actually, to look at the centralization of Treasury. For a good number of decades now, treasurers have seen the benefits of centralization. Right, they're pretty obvious when you look at it from with a treasurer's hat on, in terms of being able to manage counterparty risk, being able to manage consolidated FX risk, getting a better yield on available cash. There's all sorts of pretty sort of obvious treasury-based reasons to try to centralize operations, and I'm talking in a broad context. We'll get into the sort of more specific FX side of things as we discuss further. So this has been something that treasurers, assistant treasurers, and treasury analysts have been pushing for within multinational organizations for as long as I can remember. I started out in this business as a banker about 30 years ago, and even at that stage, it was talking to corporates about putting in place more consolidated banking structures to allow people to get their hands on cash and visibility over cash flows and FX and the likes. The problem was that there was an expense sort of associated with doing this. And CFOs and CEOs and board directors at that stage hadn't as much interest in treasury as they do now. So roll forward 20 odd years ago, Sarbanes-Oxley comes along, and all of a sudden we have board level accountability for treasury treasury information and treasury elements. So it becomes a lot more focused, and suddenly there's a lot more internal senior management focus on a lot of the treasury operations. That that gave an impetus in terms of investment and, you know, as I said, board level buy-in to achieving some of the centralisation solutions that treasurers would have been looking at anyway for a period of time. So I think that was definitely one of the key sort of drivers, and that's sort of at the corporate governance level, and that continues, Agustin, as you quite rightly have referred to, up until the present day. So we have things like the individual accountability frameworks that have been rolled out at a board level across Europe and in the US, be they under different guises. And more, I think the Treasury information, operations and risk is being brought up to the board level, and therefore centralising makes sense from an ability to manage and report on that. Coupled with that, Agustin, I think, was the fact that we had a massive systems evolution, as you guys well know, you're part of it. And if we think about the fundamental underlying need to be able to centralise Treasury, it's getting your hands on data, getting your hands on information, and understanding information. Now, they're two very different things, right? You can often get your hands on a lot of information, but not have any idea, you know, how to interpret that or how to use that. So at a very fundamental level, the rollout of pan-organisation ERP systems has really allowed there to be a central area where fundamentally important treasury operation and treasury exposures, the data is there. Now, it rarely is available from those systems in a very treasury usable way, and therefore there needs to be something kind of laid on top of that. But certainly that evolution in terms of kind of maximizing data flow within organizations has allowed for centralization. There are other developments, obviously, in the systems, like systems where, like I think very much the treasury management systems area has become very fragmented, right? Whereby now there are specialist systems to do specialist things, and they're the best at doing those things, right? So there's kind of long gone is the day really of someone getting a big treasury management system and using it to do everything. Treasury management systems obviously are important in the treasury world, but getting modular systems to lay on top of them are just as important in terms of delivering the end result. So there's been a massive evolution in that, and that's everything from, you know, like the Cantox system from an FX perspective, all the way through to things like forecasting and intercompany netting and the likes.
Absolutely.
Coupled with that, then, Agustin, you know, from a systems perspective, bank systems have come on massively, as you're well aware, and even the ability now to use multi-bank systems to consolidate information flow, cash flow, and bank balances. You know, that central information gives both the centralized reporting requirement, but also when you have that information, you can do something with it from a treasury perspective. Two more simple benefits. One, I've mentioned the financial benefits, right? If you can get your data into a good place, then there are obvious financial benefits, be that from reduced FX margins that you're paying by consolidating all of the FX, right the way through to getting your hands on cash that may have been kind of lying idle or getting a very poor return, and being able to use that to either pay down debt or invest at a much higher yield. And these are definable financial benefits, Agustin. You know, you can simply say, if we didn't have this particular centralization process in place, this is the return we would have got, or this is the FX we would have paid, whereas now we're paying this. So the measurable benefits go a long way, and again, that's all sort of systems driven. And finally,
sorry, go ahead.
Last one, Agustin. Sorry. Finally, it's the risk management, really, and this is a very big element, particularly given having come through a real life banking crisis, right, which no one kind of ever thought would happen 20 years ago, but then 15 years we were poured into it, and banks were going bust, and everybody was worried about their funds being there, and it was no longer a theoretical exercise. So now for a treasurer to be able to physically manage those financial risks, be they again kind of counterparty exposure from an FX perspective or a cash perspective, it's a major kind of enhancement in terms of the overall risk management process within an organization, and indeed kind of with the development of enterprise-wide risk management processes. You know, the treasurer has more and more been pinned to his collar in terms of being responsible for those sort of operational treasury elements. So You can see the evolution of a treasury department, moving from sort of the concept of capital management, headquarter debt management, into internal liquidity processes, internal risk management. So really there's a major evolution in all areas surrounding both what Treasury wants to do, governance, and indeed the kind of systems capabilities that are in place.
Absolutely. Now you just mentioned the fact that companies need to, or treasurers, right, to get your data in the right place, and that's a point that we emphasize a lot. Know your company, know your business, and make sure that you understand all the ins and outs. And for that, of course, the availability of data is an all-important factor. Justin, would you say that size is a matter here when we discuss centralization? Still, in general, we're going to go into the more details about FX, but in general,
yeah,
one size fits all approach is. What about the problem with size overall when it comes to centralization?
Yeah, so ironically, sometimes the very large organizations are the ones that are most difficult to centralize, because they tend to have grown out of acquisition and conglomeration and the likes. Even though they often, when you run the maths on it, are the ones that can sort of get the most benefits from it. We would always argue that any organization that has an international footprint and has any kind of reasonable level of cash flow, be that single currency or multi-currency, can benefit from a centralization approach. And it's both the financial benefit and the risk management benefit that flows from that. However, what we would not say is that there's a one-size-fits-all approach. Definitely not. If we look at the sorts of processes that we would manage here, like if we think of, for instance, cash and liquidity management, what is the most effective pooling structure for a company? That's very much going to be driven by banking relationships, by the number of currencies that entity is dealing in, by the levels of cash held in various pockets around the world, and by banking ability to service those jurisdictions. So there's definitely not a one-size-fits-all there. In terms of FX, definitely not a one-size-fits-all, and quite simply that's because every, as you mentioned, every business has a different business approach. And FX exposures, they arise in very different ways depending on how the business is set up. We sort of almost have the sort of easy exposures that arise out of centralization, which are things like intercompany loans and the significant balance sheet elements that may be in place. But the more difficult ones sometimes to identify and to manage on a consolidated basis are sort of those future cash flows, right? Hedging profitability and economic hedging and the likes. So definitely not a one size fits all. Having said that, we see certain processes that assist along the way, right? So in terms of an in-house bank, having a good cash and liquidity management system, having a good intercompany netting system, having a good process around FX hedging, and an agreed policy around FX hedging, which is implementable, and having good forecasting and reporting. They are common things. How you achieve them, definitely not a one size fits all, but they're common objectives and common elements and processes that really help an organization to get to where they want to be.
Right, and you just mentioned in-house banks. Let's discuss a little bit this before again tackling the more specific subject of FX centralization. Sure. I know you've been involved in implementing some projects of in-house bank solutions.
Yeah.
Describe to us what that entails in practical terms.
Yeah, sure, Agustin, and maybe just to set the scene, right? An in-house bank is sort of can be this wide or this wide, right? So there's a there's a very broad scope within there. When we talk of in-house banks, we are generally talking about the treasury elements of an in-house bank. So we're not talking sort of about payment factories and Bobo and Kobo and the likes, even though they often kind of hang on to the edges of the in-house banking structure. But they're generally more managed by shared services center, accounts payable, etc., etc. So what we're looking at is establishing the correct treasury infrastructure to allow an in-house bank to centralize processes. And you ask about what's the kind of life cycle, I suppose, of an in-house bank. It's quite well defined, actually, because the same issues come up over and over again. So the very initial catalyst for this is often not a requirement, but a wish or requirement for Treasury to become more efficient in the way that it's centralised its processes and managing its risks. And in order to do that, there is an initial kind of process scoping. So the concept of an in-house bank is obviously that you're able to manage all of your cash liquidity and bank risk, within a certain environment, be that a single legal entity or a treasury centre or the HQ balance sheet. It doesn't really matter. The concept is that you're putting it all in one place. And the initial step in that is to understand what processes you want to house there. Now, as I said, typically the processes we would see housed there are FX management, cash and liquidity management in terms of managing pooling structures, intercompany loan management, intercompany netting, and then cash reporting and forecasting. There seems to be they're the sort of 5 foundation points, and entities will often choose to implement 1, 2, or 3 of them as a starting point. It's not a kind of a big bang to jump in with results. So once you've identified the processes you want to initially establish in the in-house bank, and made a business case for those processes, the next big hurdle really is always the tax and regulatory considerations, right? Because obviously you're undertaking financial transactions. There'll be things like withholding tax and interest deductibility, where there are intercompany loans, and the treatment of internal FX and the likes will also be important. So that's really where you're opening up the working team, to include tax and the accounting teams. And you're coming up with the best structure put this to wrap around this in-house bank. And that, as I said, that could be could be the HQ balance sheet operating out of the US. It could be a regional treasury center operating out of Luxembourg or Ireland. It could be a special purpose vehicle operating out of the UK, or it could be a Swiss or a Swedish operation. It really doesn't sort of matter where it's based, to be perfectly honest, as long as it works for that organization and the processes can be managed on a remote basis. So following that, you now have a big picture of what you want to do, right? You know where you want to house your in-house bank, and roughly speaking, what you want to achieve from it in terms of processes. Then you're getting into a detailed design, and that's sort of, I won't spend too much time on that because you can imagine you can spend a long time talking about that. But really, you're talking about how things are going to link up in terms of information flow, process flow, and what are the touch points around the group in terms of what's going to take place in the in-house bank. And as I said, it's around those key elements, right? Liquidity management and netting, FX. They're core treasury operations, right? But they have an impact, obviously, on the operations. So you're going to expect operations to push all their funds through whatever liquidity structure you're using. You're going to expect them to undertake all their FX hedging with the central platform, and you're going to expect them to use you as the in-house lending and borrower. So there are touch points that need to be considered, and there is definitely a lead time with that in terms of bringing people along in education and the likes. The other important thing is, of course, systems implementation. So and not only systems implementation, systems integration is what I would say is the big thing there, because you're going to have different types of systems to undertake the different processes that you're looking at. They're going to have to be integrated with banking systems, with ERP systems for data, maybe with FX trading systems, whatever, what I mean, depending on where you're going on. And certainly,
and then of course is where, for example, APIs, right, application programming interfaces, will play a major role.
Correct. And again, Agustin, APIs and even just SFTP solutions, they're more and more required. We're expected in terms of automated data flow and automated results. And for instance, in terms of a product like the Cantax product, like being able to get an answer to your problem is really what you're trying to do, right? So we can have all this data flying around the place, but unless we know at the end of the day what our exposure is in Swedish or our exposure is in sterling, we don't want to be going back to spreadsheets to do that. And it's the same if it's FX or if it's liquidity management or whatever. It's about using the best in class solutions to manage the data that's available in reality. So having gone through those sort of process and those systems implementations, you end up at a position where you're ready to go live. And then, generally speaking, it's a process by process live event. But some people some people go with a big bang. It's sort of up to the individual culture. Typically speaking, if there's a culture of centralisation, big bangs are easy enough. But if these things have been done locally for many years, well, then you're kind of trying to bring people along and ensuring that they're comfortable along the way. And that includes both the subsidiaries who you'll be interacting with in terms of actual FX trading or cash and liquidity management, but also important, all of the head office functions, tax, accounting, et cetera. They all need the necessary input and feedback.
Absolutely. Now, Justin, we think we've covered the broad issues of treasury centralization in general. Let's go a little bit more into the details of, say, foreign exchange centralization. You know that we just launched at Cantox, or we're launching Cantox in-house FX. It's an automated solution for the management of currency risk between headquarters and subsidiaries, and we are sort of tackling some of the pain points there of existing solutions like high FX trading costs or the lack of traceability to assess performance from the internal trades all the way to the external trades with banks, and also maybe the lack of 24/7 liquidity for subsidiaries. All of that is now being tackled with automated solutions. And let's go into detail, if you will, to the subject of netting. You call it intercompany netting. We use the term more exposure netting. You've written that it provides lots of benefits, including savings on transactions, of course, less credit risk, better cash flow, and perhaps even the need to set aside less capital in terms of collateral requirements, right? Could you elaborate on these points?
Yeah, sure, Agustin. So yeah, like I suppose there are nuances around when you talk of netting. So when we talk netting, really there's two elements to it. First of all, there's the netting of intercompany payables and receivables, and that results then in a much more efficient balance sheet that can then be used to net the FX exposures, if that makes sense. So there's kind of a leapfrog element to it. So just to address some of the things that you've mentioned there. First of all, when we look at the netting of intercompany payables and receivables, it obviously significantly reduces down the number of gross balances outstanding, and that's without having to do any FX, Agustin. So typically in an in-house banking structure, we would not see those being cash settled, but they'd be settled against a ledger, effectively. So what you're doing is you're closing down all this web of sort of potential intercompany accounts payable and receivables, and collapsing them into a single currency exposure in the base currency of the operating entity with the in-house bank. That then would feed into a system like the Cantox system, which would go to hedge the overall group exposure in those particular currencies. And from the FX hedging, I mean, again, we run intercompany netting on behalf of a lot of clients, and really the key driver of financial results, financial benefit, is the level of FX deals that would have been required, effectively, versus those that are executed, and some of the transaction savings, as you mentioned. But the FX is by far the biggest. Just to be clear about that, we would run savings estimates, and they run anything from about $2 million to up to about $25 million a year, depending on the flows. So if you're a company that has massive intercompany flows, then you're going to be saving yourself a lot. And that's before you talk about some of the other things, Agustin, like cash flow management, understanding flows, and being able to integrate the FX element of that. Most of that is saved by being able to, as you mentioned, offset FX. So you're obviously ending up with a net FX result rather than people buying and selling various currency pairs at the same time. And then also by achieving effectively wholesale rates as opposed to kind of retail rates at a local banking level. And generally we'd look at them in tiered levels, maybe up to 10 million, up to 20 million, up to 40 million, above 40 million, or whatever. So yeah, massive opportunity really, to be honest, and something that companies have grappled with, as you well know. It seems like a relatively straightforward thing to be able to do, and in some ways it is, Agustin, in terms of balance sheet elements, because they're there, right? They're reported, they're in the ERP. But then when you get into some of the cash flow hedge and predicted flows out into the future, it becomes more difficult, and that's where real sort of systems and an element of AI and an element of intelligence comes into play in terms of knowing what might happen into the future and trying to wind that around a budget and make it make sense, make it make sense with a budget, and then all the way down, as you mentioned, to implementing the actual FX trades, which, if done properly, you can obtain significant savings just even on a competitive basis across banks or whatever.
Right. And speaking of savings, you just mentioned the massive savings on the volume of FX transactions itself, but also if you centralize those external FX trades with a head office, you would be in a position to negotiate better terms with banks. So it's the double savings there, right? And even perhaps improve your long-term strategic relations with banks. Do you agree with that?
Yeah, absolutely, Agustin. One of the things we do actually on behalf of clients is monitor bank volume and value and stuff like that, right? For one, you want to drive your FX towards your relationship banks, your balance sheet funders, effectively, and that's common treasury practice, obviously. But also, you want to be able to demonstrate to banks what wallet they're getting from you, effectively, and that can be difficult. People can struggle with that. So just even by being able to say, well, look, we did 6 billion FX across all our banks this year. You picked up 600 million of it, but if you tweak your pricing a little bit, you'll get 1 billion. Having that information at hand gives you sort of the upper hand when you're having those conversations around relationships and long-term suitability for each other as partners, as well as quite simply being able to manage your exposure better. For one, you're going to reduce your gross exposure to banks if you've got a lot of forward or swap activity in play, but also importantly, you can manage where trades get directed to if you feel you have an overexposure,
right,
to one particular bank, be that either from a credit risk perspective, or more often we see it being from a business perspective. In other words, one bank might be very strong on a very big currency pair, but no other banks are getting much wallet as a result. So you might make the choice to take a bit of pain, take a bit of financial pain in an effort to kind of share that wallet, because the greater good of having a working bunch of banks rather than a single reliance.
Right. Now, what about another benefit, which is a little bit harder to quantify, say financially, but would you not agree that by having those headquarters centralize the execution of all external FX trades, now you would have more expertise at group level, and that's an important point. Would you agree with that?
100%. we are constantly terrified when we hear of clients who are allowing their local financial controllers to undertake, significant FX activity, particularly in the forward market. They don't tend to have the systems to manage it. So it's being managed on spreadsheets. You do a 50 million forward sale of dollars instead of a forward purchase, and you don't find out till 6 months down the road. You're going to be in trouble. So definitely having the expertise to understand and implement particular FX policy, and to be able to communicate that to the local entity level, so as that they know how to put in place what level of cover they're supposed to put in place with the headquarters, is really important. And then I just wouldn't underestimate the requirement or ability to have that information in terms of exposure versus hedge, mark-to-market information, monitoring of risk movements on that, monitoring of P&L effects on that. That's very, very hard to achieve on a decentralized basis. So absolutely, I couldn't agree more. There are massive risk reduction benefits to be got by centralizing these sorts of activities. And as you say, they're not always quantifiable, but sometimes they are, in terms of looking at volatility on underlying versus hedge, etc., etc.
Right. All right. Let's tackle another subject related to the management of foreign exchange exposures. In this case, you discussed recently the topic of managing or demystifying hedge accounting. What I want to say by this is, so for example, we take a recent book by some on corporate FX risk management. So hedge accounting is really well presented. It allows us, of course, to reduce the net income volatility that arises from the different treatment of the exposure items and the hedge instruments. But the authors also argue that it's too costly, and in any case, financial analysts are well trained, and they will dismiss temporary episodes of net income volatility that may arise. What we like to say at Cantos, and I think we would agree with you on this topic, is that there's a need to sort of take it easy and demystify a little bit. So, for example, from our perspective, we tell treasurers that the tools for the traceability tools are there for you to simply automate all the requirements that are needed to perform hedge accounting. Would you agree with that?
I absolutely agree, Agustin, that the only way to implement a reasonably efficient hedge accounting approach is by correct systems usage. And if you do that, it can be actually reasonably straightforward. One of the issues, like again, if we kind of look back historically, when IAS 39 or FAS 133 was first issued, there was like a 4,000 page document on it, and it was difficult to understand, what are we supposed to be doing here, and where do we use this, and what is the practical implication of this. And at that stage, as you'll probably well remember, a lot of the big four accountancy firms were making an industry out of this in terms of,
right.
and in fairness to them, they probably had to do that in order to get to the bottom of it themselves. And some of the solutions that were proposed were actually very complex and probably overly complex in terms of their requirement. So I think there was an initial scare off of people wanting to sort of take a bite at this. And then if you roll on a few more years, things became a bit more practical. Most people focused initially not on FX really in reality, because they had bigger exposures, and if they had interest rate swaps and the likes,
Right.
which can be, the mark-to-market movement and the likes can really knock the socks out of your P&L unless you're very careful. And in fairness, those fixed income and interest rate derivatives in terms of hedge accounting are much more complicated than FX. The beauty of them, though, is that generally speaking, once you have it set up for, you know, a 5-year interest rate swap, you just leave it in the background ticking over, and it works away. Whereas on the FX side, there tends to be a lot more activity in terms of, you know, monthly hedging or hedging program and the likes. But in terms of sort of what you mentioned there in terms of complication and demystifying, Agustin, like we often would come across clients who are put off implementing what they see as the right FX risk management approach because the accounting team are scared of the hedge accounting, and we still see it to this day.
And we have, for example, seen clients or prospects shying away altogether from sound FX risk management because of the perceived costs and of hedge accounting. Which is,
and it is. So look, like when it boils down to it, right? FX hedge accounting is reasonably. It's very straightforward for on-balance sheet items. Okay, you can just take everything fair value to the P&L and you'll get it offset. It only really becomes in any way complicated, and I say that in inverted commas because I wouldn't view it as being so. When you're looking at cash flow hedge accounting, and really once you have developed a pretty reasonable forecasting approach and have defined the hedge documentation properly in terms of, you know, the risks you're trying to cover and how you sort of document that. Really, once you've done that once, it's just a case of we have an Irish saying here which is called lean the barney. It means fill in the gaps. You know, you're really just replicating what you've done before because you've created a proper infrastructure and framework and system to do it. There are, you know, little simple techniques like, you know, everybody will know these, right? But like, you know, not instead of doing a, you know, 100 million forward hedge, do 10 million. So, you know, if one's ineffective, it's only a 10 million mark to market, not 100 million. Having a reasonable way of defining actual cash flows versus hedges to prove kind of effectiveness of the hedges. Again, no big deal. You know, it can be done using systems in a relatively straightforward manner. And then really it just becomes a case of being able to produce the accounting output. Most TMSs now will do that for you as long as you have a decent accounting team that will know how to do it. Really the key to this we found is to pump the accounting output directly into the ERP, so the accounting team can be happy with it and they don't have to sort of necessarily worry about it, right? And Treasury therefore is taking responsibility for sort of the hedge documentation and stuff like that. And again, as I say, that doesn't have to be, you know, if you set it up right, that can be a very efficient process. So like I think, you know, we've got and as you know, things have changed with IFRS 9 and the likes as well. So things have become a little bit, you know, a little bit easier. But like there is no reason for any company at this stage to be scared off doing the right thing from a risk management perspective because they think the accounting is going to be too overwhelming.
Absolutely. Well, Justin Callaghan, CEO of FTI Treasury, thank you very much for having discussed today a wide range of topics. We started out with Treasury centralization in general. I sort of asked you whether you thought it was something that was so due to the latest events like the pandemics, the inflation, the wars, and even some bank failures, but you put it in a broader context going back at least 30 to 40 years. So really interesting.
Agustin, don't age me too much.
Right. And then we went on to discuss all the massive benefits of Treasury centralization, FX centralization in particular, netting, and you agreed, of course, that it also allows us to build up expertise at head office level. So a really important point. Finally, we just discussed a little bit the demystification of hedge accounting. Justin, is there something you would like to add?
No, of course, it's been a pleasure talking about these things. As I mentioned, we specialise in providing outsourcing services to multinationals. So our door is always open to talk to people about all these elements. So hop over to our website if you wish to do that.
Perfect. Justin, thanks a lot, and we'll see each other soon.
Thanks, Agustin. See you.
Goodbye.